In 2023, a study from Coldwell Banker found that 60% of American millionaires held real estate as a significant part of their wealth, not as a side bet, not as a hobby, as a core pillar of how they built and sustained net worth over time. And yet most people who want to build wealth spend years looking at stocks, crypto, side hustles, and savings accounts, while quietly walking past the asset class that has quietly made more ordinary people wealthy than almost anything else in financial history. The reason is not that real estate is complicated. The reason is that nobody has ever sat down and drawn the map clearly, shown the actual path from zero properties to financial freedom, explained not just what to do, but exactly how the numbers work at every stage of the journey. My name is Tomas, and this channel is about finance, automation, and building real, lasting wealth through strategies grounded in evidence and real-world results. If you are new here, welcome. Hit that like button right now and subscribe so you never miss a video. Today, we are drawing the complete millionaire map through real estate, from the first property purchase all the way to a portfolio that generates income for life. Let's get into it. Let us start with the question that stops most people before they ever begin, and answer it once and for all. Do you need to be wealthy to start investing in real estate? The short answer is no, and the longer answer reveals something important about how real estate wealth is actually built. Unlike the stock market, where your return scales directly with the amount of capital you deploy, real estate allows you to control a large asset with a relatively small amount of your own money. That concept, using borrowed capital to acquire an asset worth far more than your down payment, is called leverage. And leverage is the engine underneath every significant real estate wealth story. Consider this example: a property worth $250,000, purchased with a 20% down payment of $50,000, gives you complete control over a $250,000 asset. If that property appreciates in value by 5% over the next 12 months, it is now worth $262,500. Your $50,000 investment has generated $12,500 in appreciation alone. That is a 25% return on your invested capital from a 5% increase in property value. No other commonly accessible investment vehicle amplifies returns this way. This is why the starting point for real estate wealth does not require millions. It requires a down payment, which, for investment properties, typically ranges between 15 and 25%, combined with the knowledge of what to buy, where to buy it, and how to make the numbers work. Those three things are learnable, and learning them is the first step on the map. The market selection decision: where you buy matters as much as what you buy. One of the most consequential and least discussed decisions in real estate investing is market selection. Buying the right property in the wrong market produces mediocre results at best. Buying a decent property in a fundamentally strong market produces extraordinary results over time, because the market itself works as a tailwind behind every decision you make. Strong real estate markets share several characteristics: population growth, cities and regions attracting net new residents through job creation, quality of life, and economic opportunity tend to see sustained housing demand. Job market diversification. Markets dependent on a single employer or single industry are vulnerable to downturns that can crater property values and rental demand simultaneously. A landlord-friendly legal environment. States and cities with clear, fair eviction processes and reasonable regulatory frameworks protect investor cash flow in ways that heavily tenant-favored markets do not. And a favorable price-to-rent ratio. The relationship between what a property costs to buy and what it can rent for determines whether the property can generate positive cash flow from day one, or requires years of negative cash flow to eventually break even. Researching market fundamentals before committing to a location is not optional. It is the foundational step that separates real estate investors who build consistent, compounding wealth from those who buy the wrong property in the wrong place and spend years trying to recover from it. The property selection framework: what makes a rental property worth buying. Once a strong market is identified, the property selection process comes down to one overriding question: do the numbers work? Not whether you like the property, not whether you would want to live in it, whether the financial case for ownership is sound at the purchase price being offered. The most fundamental calculation in rental property analysis is the cash-on-cash return, the annual cash flow generated by the property divided by the total cash invested to acquire it. A property that generates $4,000 in annual net cash flow after all expenses and purchased with $50,000 in total cash investment produces an 8% cash-on-cash return. Whether that is acceptable depends on your local market, your strategy, and your alternatives. But having a clear minimum threshold before you begin evaluating properties protects you from the most common mistake in beginner real estate investing, which is falling in love with a property and rationalizing the numbers afterward. Beyond cash-on-cash return, a sound rental property analysis includes the gross rent multiplier, the purchase price divided by annual gross rent, a quick filter for relative value, the net operating income, which is gross rental income minus all operating expenses excluding the mortgage, and the debt service coverage ratio, which tells you how much cushion exists between income and debt payments. None of these calculations requires a finance degree. They require a spreadsheet, honest numbers, and the discipline to walk away from properties where the math does not support the investment regardless of how attractive the property looks on the surface. The BRRRR Strategy: How to Scale a Portfolio Without Unlimited Capital. One of the most powerful frameworks for building a real estate portfolio over time is the BRRRR Strategy, an acronym for Buy, Rehab, Rent, Refinance, Repeat. It is the mechanism that allows investors to recycle the same capital through multiple acquisitions rather than needing fresh down payment money for every new property. Here is how it works in practice. An investor identifies a distressed or undervalued property, one that needs cosmetic or moderate renovation work, and purchases it below its post-renovation market value. They renovate the property to bring it up to rental-ready condition, increasing its appraised value in the process. They place a qualified tenant, establishing the rental income history that lenders will use to evaluate the asset. They then refinance the property at its new, higher appraised value, pulling out a cash-out refinance that returns much of the original down payment and renovation capital, and they repeat the process with the recovered capital in the next acquisition. Done correctly, BRRRR allows an investor to acquire properties with relatively limited initial capital and build a portfolio of 3, 5, or 10 units far faster than a traditional buy-and-hold approach would permit. The risks: renovation cost overruns, delays, appraisal values that come in lower than expected, are real and require careful management. But investors who execute this strategy with discipline, conservative underwriting, and strong contractor relationships have built portfolios worth millions, starting from a single acquisition and a few $100,000 in starting capital. The long-term compounding picture: what the portfolio looks like in 10 and 20 years. Real estate wealth is not built in a single deal. It is built in the compounding of multiple forces: appreciation, cash flow, loan paydown, and tax advantages, working simultaneously across multiple properties over an extended period of time. And when you model what that actually looks like over 10 and 20 years, the results are striking. Consider an investor who acquires 3 rental properties over the first 5 years of their real estate journey. Each property was purchased at $250,000 with a $50,000 down payment. Total capital deployed: $150,000 across all 3 acquisitions. 10 years later, assuming modest 3% annual appreciation across all 3 properties, consistent rental income with reasonable vacancy, and normal loan paydown, each property has appreciated to approximately $336,000. The combined portfolio value is over $1 million. The combined equity, the difference between current market value and remaining mortgage balances, is substantially higher than the original $150,000 investment. The combined monthly cash flow from all 3 properties, with rents having grown modestly over a decade, may be producing $2,000 to $3,000 per month in net income after all expenses. The combined depreciation deductions are sheltering that income from taxation, and the tenants are continuing to pay down the mortgages every single month. None of those numbers require a perfect market. None of them require elite deal-finding skills or sophisticated financial engineering. They require 3 reasonable properties in 3 fundamentally sound markets, managed competently over a decade. That is what the millionaire map through real estate actually looks like when you run the numbers honestly. Not a fantasy, not a promise. A mathematical outcome available to anyone willing to learn the fundamentals, deploy capital intelligently, and stay patient long enough for compounding to do what compounding always does. The mindset that separates investors who complete the map from those who stop at the first property. Every successful real estate investor has faced the moment where continuing felt harder than stopping. The difficult tenant. The expensive repair that arrived at the worst possible time. The market that moved sideways for 2 years when appreciation was expected. The refinance that did not come in at the appraised value anticipated. These moments are not exceptions in a real estate investing career. They are the rule. They happen to every investor at every level. And the investors who ultimately build extraordinary wealth are simply the ones who treated each obstacle as a problem to be solved rather than a signal to quit. The mindset required is not optimism. It is resilience combined with continuous education. Every challenge a property presents is a lesson in property management, tenant selection, market analysis, or financial structuring. Every lesson makes the next property cheaper, smoother, and more profitable to acquire and manage. The learning curve in real estate is steep in the first 2 or 3 years and then flattens dramatically as the investor's knowledge base catches up to the complexity of the asset class. The investors who make it through those first 2 or 3 years with their properties intact and their conviction unbroken tend to stay in the game for decades. And the wealth that builds over decades in real estate is the kind that changes not just a life but a family's financial trajectory for generations. So there is the millionaire map, drawn clearly, with the numbers and the path laid out from beginning to end. Leverage as the starting engine that allows ordinary capital to control extraordinary assets. Market selection as the foundational decision that determines whether everything else works. A rigorous property analysis framework that protects against the most common and costly beginner mistakes. The BRRRR strategy that allows a portfolio to be scaled without unlimited capital. The long-term compounding picture that shows what 3 properties, managed competently over a decade, actually produce in real wealth. And the mindset that holds the entire map together when the inevitable obstacles arrive. Real estate has made more ordinary people wealthy over more centuries than any other asset class in history. The map has always been there. Now you know where it leads. Take the first step. If this video gave you a clear picture of the path forward, please hit that like button. It truly helps this channel grow. And if you are not subscribed yet, click that button right now so you never miss what is coming next. See you in the next one.